Remember that time your friend tried to charge you double for a bag of chips just because you wouldn't share your biscuits? That, my friends, is a microcosm of tariffs. Now imagine that on a global scale, with countries playing the roles of snack-hoarding toddlers. In 2018, the Trump administration decided to slap hefty tariffs on steel and aluminum imports from Canada and Mexico. The goal? Boost American industries. The reality? Well, like most things in economics, it's complicated. In simplest terms, tariffs are taxes on imported goods. They make foreign products more expensive, theoretically making domestic ones more attractive. Think of it like this: you're at the pub and a pint of domestic beer is a $5, but your mate, let's call him Canada, is offering a fancier imported brew for £6. Along comes the government, slaps a £3 tariff on that import, and suddenly, your mate's beer is £9. You sticking with the domestic pint now, aren't you? But what happens next? When a country like the United States imposes tariffs, it sets off a chain reaction. These tariffs are essentially taxes on imported goods, making them more expensive. The idea is to protect domestic industries from foreign competition, but the reality is often more complex. Well, Canada and Mexico in this case aren't too chuffed about the tariffs. They see them as unfair moves that disrupt the balance of trade. So what do? They might retaliate with tariffs of their own on American goods, like say those delicious peanut butter cups you love. These retaliatory tariffs mean that American products become more expensive in Canada and Mexico. Suddenly, your favorite treat just got a lot pricier, but it doesn't stop there. Consumers in all three countries start feeling the impact. Higher prices on everyday items mean that people have to adjust their budgets. This can lead to decreased consumer spending, which affects the overall economy. This back and forth is what we call a trade war, and nobody wins in a trade war. Trade wars can escalate quickly, with each side imposing more and more tariffs. This tit-for-tat approach can strain international relations and create economic uncertainty. Meanwhile, businesses in all three countries that rely on those now more expensive imports, they start feeling the pinch. Companies that depend on imported materials for their products face higher production costs. They might have to cut costs elsewhere, which could mean layoffs or reduced investment in growth. Workers and business owners alike find themselves in a tough spot, trying to navigate the financial strain. Their costs go up, they might have to raise prices, and consumers end up paying more for everything. Not ideal, right? In the end, tariffs can create a ripple effect that touches every part of the economy, from the factory floor to the grocery store. And what about the US dollar? Economic uncertainty and trade tensions can lead to fluctuations in currency value. If investors see the US economy as unstable, they might move their money elsewhere, potentially weakening the dollar. The mighty dollar. Will it rise or fall? The US dollar has long been a symbol of economic strength and stability. But in today's volatile global market, its future is anything but certain. Now, where does the US dollar fit into all of this? The value of the dollar is influenced by a myriad of factors, from domestic policies to international trade agreements. Well, when a country imposes tariffs, it can potentially make its currency stronger in the short term. Tariffs are essentially taxes on imports, and they can affect the flow of goods and money between countries. How? Remember Canada getting annoyed and slapping tariffs on American goods? This kind of trade war can have significant repercussions. This can make American products more expensive abroad, potentially reducing demand for them and the US dollars needed to buy them. When foreign buyers need fewer dollars, the demand for the currency drops. Less demand for something usually means its value goes down. But the story doesn't end there. However, it's not quite that simple. The global economy is interconnected, and various factors can influence the dollar's value simultaneously. Tariffs can also lead to inflation, those rising prices we talked about, which can actually weaken a currency over time. Inflation erodes purchasing power, making each dollar worth less. Confused yet? Join the club. The interplay between tariffs, inflation, and currency value is complex and often unpredictable. Economists and analysts spend their careers trying to make sense of it all. So will the mighty dollar rise or fall? Only time will tell. But one thing is certain. The journey of the US dollar is a fascinating one, full of twists and turns that reflect the broader economic landscape. History repeats itself? Maybe, maybe not. In the 1930s, the US enacted the infamous Smoot-Hawley Tariff Act, meant to protect American businesses during the Great Depression. The result? Retaliatory tariffs from other countries, a global trade war, and, surprise, surprise, the depression actually worsened. But hold on, the relationship between tariffs and currency isn't always so clear-cut. There are tons of other factors at play. Global demand, interest rates, political stability, that can influence a currency's value. So what's the verdict? Spoiler, it's complicated. Predicting the long-term impact of tariffs on the US dollar is about as reliable as predicting the weather 6 months out. Just like weather forecasts, economic predictions are fraught with uncertainties and ever-changing variables. One day the forecast might be sunny and bright, and the next it could be stormy and bleak. There are simply too many variables. From political decisions and international relations to market reactions and consumer behavior, each factor plays a crucial role in shaping the economic landscape. It's a complex web of interdependencies that even the most seasoned economists find challenging to predict accurately. What we do know is that tariffs can disrupt global trade, potentially harm economies, and create a ripple effect that touches every corner of the world. When countries impose tariffs, it can lead to increased costs for businesses, which often get passed down to consumers, and leave everyone feeling a bit worse off. Small businesses might struggle to stay afloat, and consumers might find themselves paying more for everyday goods. The uncertainty can also lead to decreased investment and slower economic growth. So the next time you're tempted to charge your mate double for a bag of crisps, think about the broader implications. Just as tariffs can strain international relationships and economies, overcharging your friend might strain your personal relationships. Just remember the cautionary tale of tariffs and the US dollar. It's a reminder that economic policies have real-world consequences. They can affect everything from the price of goods to the strength of international alliances. It might not end well for anyone. In the end, the goal should be to find a balance that promotes fair trade and economic stability, ensuring that everyone can benefit from a healthy, thriving global economy. If you found this video insightful, please like and subscribe to our channel, Express Econgeo Finance Insights. And don't forget to leave a comment below with your thoughts.